One of the things that we'll talk about today is normalizing the income statement. Normalization takes the raw data from the tax return and then presents it after removing the impact of activities outside of normal operations. So the purpose of the tax return is to indicate taxable income, but it has frequently activities that are outside of regular operations that may be related to financing activities like interest expense or investing activities like the sale of a business asset. And we want to understand first, those all have a taxable impact. But secondly, they're not part of normal operations. When we have interest expense, it's reflecting how the company has financed their assets or sourced their capital. That would be a financing activity, interest expense. Normalizing the income statement is a fundamental and very important aspect of our valuation. So let's talk about that. The primary goal of normalization is to reflect the regular operating activities of a business. In our introduction, we talked about two items, interest expense and the sale of business assets, which were from financing activities and investing activities. And the result is that this ensures that our performance analysis and our value calculations are consistent and representative and provide a good financial foundation. Because we remember that the activities reported on the tax return often include management-controlled, discretionary, or non-operational events for tax purposes. Another way that we can look for resources to understand normalizing is coming to the website, the BizProValue website, and we're migrating this resource into the portal. So I presented the question, how do I normalize the income statement? And Agnes returned this information to us from the knowledge base. We can identify and remove non-operational income and expenses, such as those financing activities or investing activities. Secondly, we can adjust owner discretionary expenses like owner salary and sometimes rent expense when it is owner-occupied property. These amounts may be influenced by ownership and don't necessarily or may not necessarily reflect market rate. So we want to look at those items that are discretionary. We may want to reclassify or align certain expenses depending on what the chart of accounts is in one year versus the other. In the tax return, there may be a change of the tax preparer A, tax preparer B in subsequent years, and sometimes that classification may be different. And the beautiful thing about TaxTrack and BizProValue is that when we import that tax return and the other deduction statement with a detailed project, it will automatically aggregate a common chart of accounts or a chart of accounts that is common to all years, whether or not that particular account was used in any one given year. We can see those expenses. However, we may need to align other expenses or income areas, and one of those income areas could be other income. So when they perform a service, they have to obtain a permit or a fee. They have an expense for that, but they recognize that income as other income, perhaps to differentiate that type of income from the sale of a typical product and service. However, we may want to take that other income and reclassify that out of other income and into general sales. And we'll want to be able to stipulate or provide evidence, a note in our adjustment, so that that adjustment survives. Remember that we're creating a report primarily or initially for the seller. We're creating a broker opinion of value for the seller. We're gaining their confidence. We're providing information to help us acquire a listing. Then we're presenting that information to a buyer, and that buyer is going to receive that information, and then in their own due diligence period, they're going to start asking questions. Next, that complete package may be submitted to a lender, and that lender is going to ask a lot of questions, typically more so than a buyer would, and that underwriter is going to have to look at that other income and we'll typically assume that it is unrelated to operations. So if we are reclassifying that, we need to stipulate, and the sooner we do that, the better. The sooner in our discovery we ask what that is, we have more and clear evidence to survive that underwriter scrutiny. We may want to reclassify and align certain expenses, and again, document each expense with explanatory notes. And I have my balance sheet and I have my income statement. However, in this version, I can click on the year and I can see that I've made my adjustments. And we've programmed FinTract to recognize the adjustments and the notes. So you can see what I've done here. I've taken owner 1, 2, and 3. We've indicated that owner 1 is the primary owner, and owner 2 and owner 3 we reclassified. Here you can see that I've taken my owner 2 and my owner 3, and I've reclassified that from officer compensation to salaries and wages. You can see that the sum of that adjustment was $239,000, the addition of any changes made here. So I'm not increasing expenses or decreasing expenses at all. I've simply reclassified those expenses from officer compensation into salaries and wages with my notes, and that's for year 25. And you can see that I have the same thing for 24 and 23. The primary point of our illustration here is how we've reclassified the second and third owner out of compensation of officers and into salaries and wages. And the reason why we're doing that is because we're valuing this business on a 100% control basis. That means that there's a single owner who has 100% control of the company. That means that it requires that we have one owner, and we reclassify those additional owners into salaries and wages. Now, I could have made further adjustments. For example, I could have adjusted this owner compensation to market rate, and I could have adjusted this to market rate. If I were doing owner 1, adjusting it to market rate, it's pretty straightforward. I insert either a positive or negative number to increase or decrease that normalizing amount. If I'm reclassifying and adjusting to market rate, that requires 2 steps. And what I do is I take out at the full rate and I add in at that market rate. For example, let's say that this owner 2 was paid at market rate, but let's say that owner 3 was paid above a market rate. Let's put that at, say, $100,000. Okay, that's how I would have made that adjustment. EBITDA is unchanged, SDE is overstated, and the value is overstated here. There will always be some differences in the market multiples here, but this indication of value based on SDE is overstated because SDE itself is overstated. I'll show you what I mean. So let's save this, and now let's come back to version 1. We have properly reclassified these items, including our positive amount here. And if we come to most probable selling price, now we see our value for EBITDA, and our EBITDA is unchanged, $1,055,000, and our value is stated properly. But now the value based on SDE is considerably lower, and it is correct. SDE is now representing a one owner for a 100% controlling basis, so that this value is now correct. Previously, SDE was overstated, and the value based on SDE was overstated. So the impact is, if we don't reclassify that, we will overstate seller discretionary earnings and the value based on seller discretionary earnings. Now, in this case, it may have been not extremely critical, because most deals that I am valuing that are, we'll say, over $1 million in value, it's highly likely that I would put a 100% weighting on EBITDA. So even if my SDE was overstated, I'm not going to rely on that, but I like to always set my SDE proper so that I'm reflecting true values. And in this case, even my revenue number is reasonably close too. So now I have, I think, a very solid threefold indication of value from revenue, EBITDA, and seller discretionary earnings. And so the impact is, the more clear and transparent that we can be in all of our classifications, it will better indicate our estimate of value. Here I have this value of $646,000 at the 50th percentile. If I change this based on my assessment of profitability, higher performance of the subject company relative to its peers, relative to a conservative estimate, allowed me to take this, come up to this 65th percentile, and increase the selling price from $646 to $698. That's over an 8% increase, $52,000, which is a lot of money for the seller. It's a lot of money for me too, from a commission standpoint, as a percentage of that sale price. But here I have a $698. I can still come to my financing model and look and see what my debt service coverage is and say, great, I'm still very strong. But I'm going to do one more thing. I'm going to come to performance comparison, and I'll come to EBITDA, and I'll see its performance is greater, but I'm also going to look at this cash conversion cycle. As a new buyer, I might be challenged to think, are those same creditors going to issue or allow me 51 days to pay bills? Maybe this customer has been with those vendors for many years and maybe has some special payment terms. It's certainly worth inquiring, but this might say that the cash flow is not happening as quick as our profit would indicate. We're taking a longer time to collect our receivables and a longer time to pay our payables. So that when I come to most probable selling price, I might take this 65th percentile and I may decrease that. That was a $19,000 difference. Let's put it down here. That's about a $35,000 difference. So I'm going to pay less for this business, in part because I'm going to need more capital, more working capital. I'm going to have to perhaps pay my bills more quickly. That's going to give me less available working capital and to manage cash flow. So as a broker, I might indicate my adjustment. Here I found superior profitability and inferior efficiency. As a result, first, increase my selling price based on profitability, and I decreased my price based on efficiency. Today, we talked about the importance of normalizing the income statement. We went to BizProValue, the homepage, and we asked Agnes for instructions. We made an adjustment to reclassify the second and third owner from officer comp into salaries and wages so that our valuation would be on a 100% controlling basis, which then gives us a good fundamental basis to look at and assess performance and assign value. Lastly, we looked at our profitability ratio analysis, and we found that profitability was higher than the comparison group, but efficiency was lower than the comparison group. And so we let both of those areas of performance impact our setting of most probable selling price.